Hello and welcome everybody in the audience to this panel, which, as Manuel said, will focus on how institutional investors can and are investing to mitigate climate change, as well as financing adaptations to the changed world we know awaits us. My name is Michael Hurley. I write for Environmental Finance magazine, a provider of news and analysis and an events organizer based in London. We cover a broad array of topics, including, to name just a few, ESG data, sustainability bonds, renewables, stranded assets, policy and regulation in the realm of sustainable finance, but also areas of emerging investor interest, including forestry and regenerative agriculture, or natural capital investment, as many term it. So last year, Environmental Finance also launched a separate part of our website dedicated to impact investing. So I'll just kind of bring that all together and say, much like the far-reaching nature of today's conference agenda, I think the breadth of those topics is a reflection of the complexity and the sophistication of this area of investment. And I think that's why discussions like today's are so important. So it's a pleasure to bring together so many esteemed speakers. Obviously, investors coming to terms with climate impact have to navigate a rapidly evolving set of demands across multiple fronts, be that regulatory data or otherwise. So hopefully we'll explore some of those factors in today's discussion. Before we begin, I'd just like to remind you and kind of go back to something Manuel said, that we will have time at the end of today's session to take a few of your questions. So as we go through the session, please do send your questions in using the chat function on the side of the page in front of you. We should have about 10 minutes or so to go through those. And before we delve into the in-depth discussion, I would just like to ask each of my panelists in turn to very briefly introduce themselves, their background, and perhaps provide a high-level description of where they invest to mitigate climate change or adapt to its effects. Some are multi-asset investors, others specialised in publicly listed equities or debt or private markets. So it might be helpful at the outset to kind of make those distinctions clear. So first, if I may, I'd just like to start with you, Peter, from Alecta. And would you mind just running us through very briefly in a high level for about a minute or so, in what areas you're seeking to invest for climate mitigation or adaptation? If you wouldn't mind just summarising at the outset.
Okay, well, thank you, Michael, and thanks for having me on the panel. As you might know, Alecta, we're a Swedish pension fund. We manage about $125 billion in assets, primarily in-house by our own PMs and analysts. It's a broad topic when we talk about climate, and I would say that it has an impact on pretty much all asset classes. And as a pension fund, we have a big chunk of fixed income holdings, quite large equity portfolios, some real assets as well. It really trickles down through to each and every PM, basically, to integrate climate in different ways. Obviously, in some cases, it's about mitigating risk. In others, it's about finding opportunities, of course. And I think in the end, it's all about making sound investment decisions to take climate aspects into account. And I think we're just seeing the beginning of sort of the integration of climate aspects. And I'd be happy to take a deeper look throughout the panel here of what we're doing in the different asset classes.
Of course, we'll come back to you later on. Thanks very much for your introduction, Peter. And next, I'd just like to ask Jessica, if I may. Jessica, can you come in and same kind of brief summary of how you're looking at this area and what you're doing at JP Morgan?
Sure, absolutely. Thank you, Michael. Good to be with you all. So I specifically actually sit within the private bank in JP Morgan. So important to distinguish that I am not the global head of sustainability for the entire bank. But what I'm doing is really, and of course relevant to this panel, is thinking about ways to help our clients in the private bank deploy capital with climate in mind. So very similar to what Peter said, we think of that across asset classes. So certainly not just one asset class within our approach. And we do think of it in terms, and I can get into this in plenty more detail. But in terms of that kind of risk mitigation posturing, as well as really we're digging deep these days into finding solutions for our clients. And we know that we're able to do that now across asset classes. And it's a big focus for us in the private bank, not just even in terms of the clients who feel, an imperative and, sort of almost a values-based awareness around climate issues, but honestly, just for clients, every clients, in terms of a growth opportunity for clients, because this is a massive transformation underway. And so there's plenty of ways that I'm sure we'll get into to think about those opportunities and as growth areas in the portfolio. So we're talking about high net worth clients, endowments and foundations, et cetera, and really helping them weave climate into what they're doing in their investment portfolios.
Perfect. Thanks very much. As before, we'll come back and explore those themes in a lot more detail later. Next, I'd like to move over to introduce Andrew. Andrew, would you mind, again, kind of summarizing the areas you're investing for climate mitigation or adaptation and kind of which asset classes, perhaps, which types of investments you're looking at? Andrew? Oh, I think you're on mute, Andrew.
That might be better. I beg your pardon.
That's okay.
So it's obviously I'm out in Asia. It's evening time. We're really focused on in climate mitigation around helping investors and corporates address both their needs to deploy into clean energy and also their requirements to clean up their supply chains. Given how big a part of the supply chain globally Asia represents, that's a reason why we have a focus here. But we also do that across Europe. And also into emerging economies such as Africa, where there's a big need for electrification, and there's a good opportunity still to make that clean energy the first time round rather than substituting fossil fuel energy for clean energy later in the cycle. So the group overall has a pretty much a global footprint. We are an asset manager. We do manage money in-house around climate and impact. We've been doing it for about 20 odd years. It's quite our track record. But ultimately, we've seen a big shift towards the need to clean up energy footprint rather than just looking at it as an opportunity to invest for a certain return. And that need is a powerful opportunity to be a financing arm of the change.
Okay, that's great. Thanks very much, Andrew. Next, I would like to turn to Holger. Holger, could you again just introduce yourself and the ways you're investing for climate mitigation or adaptation?
Yes, sure. Thank you, Michael. So I'm managing a fund called Environmental Impact Strategy, and it's investing in listed equities. The strategy is part of our public stock market offering for thematic strategies, where we follow a pure play approach, which really means we require companies to have 50% sales exposure to positive environmental impact in this case. So we are really interested in solution providers. For example, you could think of companies that help to improve resource efficiency by introducing innovative, sustainable materials, or companies really providing the solutions to enable the switch from burning fossil fuels to renewable energy. So those are the companies we're most interested in. Yeah. Perfect,
great, Holger. And I would just say that we were hearing you fairly quietly, but I could just about make out what you were saying. So perhaps, I don't know if when we come back to you, maybe you can hold the microphone slightly closer, but that's perfect. So next, and finally, last but not least, Alan from Wellington. Please, would you perform the same function and just give us a brief introduction of how you're looking at this topic?
Sure, terrific. And thank you, Michael, for having us or for having Wellington today. We appreciate the opportunity to dialogue with you and your audience. The investment platform at Wellington is both equity and fixed income oriented. We do have a number of strategies focused on investment in climate opportunities as well as broader impact themes. The strategy that I focus on is a climate strategy that is similar in description to what Holger was saying in terms of investing in companies for which over 50% of their revenues come from some type of climate solution, which we thematically define as climate mitigation or climate adaptation. importantly, this is not just a renewable energy or clean tech fund. And we have found over time that the opportunity set is quite broad and much more robust than a pure focus on renewables, although that is an important theme that we think will be critical in the years and decades ahead. And as a result, we have been looking at this opportunity for now going on 13 years. It's a relatively long tenured strategy and portfolio, and we continue to find more broad opportunities perhaps than other investors may be thinking about as it relates to this theme.
That's great. Thank you, Alan. So we've heard from all of today's speakers. Just to bring it back to Peter to kind of go into some of the things that you mentioned at the outset in a little bit more depth. So kind of acknowledging, you said investing across assets, equities, real estate, well, across assets. And I would be keen to dig a little bit deeper into what areas a large asset owner like Alecta deems important to in terms of investing for climate mitigation or adaptation. How are you thinking about that? And how does that apply to some of the asset class that you're investing in?
Yeah, sure. Let me start then with the fixed income portfolio, which is the largest part of Alecta's portfolio. And there, I mean, we tend to focus on green bonds. It's a very sort of today. It's a very standardized format of making climate impacts investments. I think we build up a portfolio now of about $6 billion of green bonds. So it's a fairly large share actually of our portfolio. And then the problem there is that we're seeing such a huge demand for green bonds, at least here in the Nordics, that it really pushes the limit on the pricing of those bonds, which means that we're opting out a lot these days because they're just too expensive. But it actually shows, the demand from the investor side. So I'm seeing or foreseeing that the issuances of green bonds will almost become sort of standardized for many corporations, just in order to get their financing. So that is one way, is an easy way, I would say. Going over to listed equity, I think it's a bit trickier. I'd be happy to hear now from Holger and Alan, talking about their strategies. But there we have an ESG integration sort of approach, where we look for basically we're looking for long-term business models, and that means that we need to take these climate issues into consideration. And we've actually have a portfolio without any oil and energy companies at all. We hardly have any sort of high emitting sectors, just because of the risk we see in those particular sectors. So it is a bit more tricky, but then on the other side, there are plenty of opportunities then within the equity space, of course. We try to follow up in our portfolio. We obviously engage with the companies. Since we ourselves have a climate target of being climate neutral by 2050, we obviously ask that question to the companies. Do they have sort of the same commitment, so they're aligned with us? Because in the end, our target is dependent on holdings basically reaching the same target. So we very much encourage companies to science-based targets. But I'd be happy to hear Holger and Alan tell me a little bit more about what you can do within the listed equity. But I thought I wanted also to mention the real assets, because real assets is also a big part of any pension fund, I would say. The assets there are quite a good fit for a pension fund that has liabilities. You have a steady income stream for those assets, and they're obviously in real estate. I think we've been working with climate aspects for many years, because it's such an easy calculation. You make the properties more energy efficient, and you bring down cost, and you rises the valuation. So it's a very very simple calculation there. And in infrastructure, I think it has the most potential actually, because there's a huge demand then for infrastructure investments next 10, 20 years. The problem there for us is actually to find projects that are economically viable for us. Again, it's a supply thing, and we're not just seeing as much supply as we would wish. So let me stop there, and I'll jump in later after the other panelists have their say.
Well, that's great. Just very quick question, coming back to you on one thing about green bonds in particular. You mentioned the kind of the pricing aspect, and a discussion that I was having with my editor actually about this, because ostensibly there isn't the difference between a vanilla or unlabeled bond and a green bond is obviously the allocation to a defined set of proceeds, use of proceeds, but the pricing aspect, the discussion around the pricing aspect and whether that should merit a better or worse pricing is kind of a loaded issue, I suppose. Where do you kind of see that heading? If we've seen, anecdotally, I've heard over the last year or so, the pricing has become more outsized, and so it's kind of certainly hearing what you were saying about that as well. Where do you see that heading if that issue continues?
Yeah, I mean, for us, it's a problem because we don't have the mandate to actually pay that extra the greenium, basically. Again, if you look at a fixed income asset, it's basically it's a credit risk that we're taking on, and we are not there to take on that pay the extra price for it. Although it is a difficult because we obviously really like the green bonds, because again we're seeing where the proceeds are going, and it has an impact. We get the impact reporting, but how much should we pay for that? 1 or 2 basis points, that's fine. But when it gets to 5 or 10, and we've seen issuances of 20 basis points, that's a little bit too much for us. So I'm hoping that sort of the supply will solve that problem.
And is it true to say that has been more of an issue over the last year or so, would you say?
It's been more prominent, at least. And I totally understand sort of the treasurers, jumping on that boat and take that, those extra points. But when we invest in sort of SSAs, we don't see that greenium as high, because they want to, price at the curve. So then we don't see that greenium. But we will see where it goes, actually.
Yeah. Well, that's an interesting discussion, and I think if we have time, we'll return to some of the other things that you raised as well. It's very, very interesting to hear what you're doing at Alecta. But now I'd like to move on, and Jessica, I'd just like to posit the question to you. So we're talking about how JP Morgan Private Bank clients typically include high net worth individuals, wealthy families, endowments, and foundations. Can you talk a bit about what type of investments they're looking for, and by extension that you're looking for your clients? If you wouldn't mind starting there, and we'll take the discussion on from there.
Yeah, sure, absolutely. And I actually should have mentioned, even when I was giving my intro, that I think I mentioned high net worth or ultra high net worth. Important to mention, actually, that what we do in kind of the investment solutions part of the business in the private bank is also serving down to our Chase Wealth Management. So this is not just for the ultra rich. We are really building solutions and offering vehicles that get down to just everyday people who want to invest in this. And I think that's really important because people tend to think that this is for the ultra wealthy, or it's very expensive, or it's very difficult, and it's not. So what they're interested in, I'd say there's various different flavors. Like climate is just this big issue, but people have a very different view on how to execute that in a portfolio. So I think of it sort of like a spectrum of what we're trying to build to align with those preferences, which is at one end, there's obviously just a get rid of it entirely, a pretty a divestment approach to just removing oil and gas, coal, et cetera, from the portfolio, the highest emitters. But even sort of within that same category, but but a bit of a different flavor. It's just even low carbon, because instead of just saying you're going to exclude entirely, you could actually look at every sector and say within each sector, it's not about removing a sector, it's actually about lowering the exposure to carbon and high emitters within each sector. And arguably, some would argue that the total portfolio then is left with less carbon than if you had done it the other way. And then you start to move into, Peter rightly mentioned in listed equities, people turn to ESG a lot. So that again is across all sectors, just thinking about who kind of the leaders are, or at least just embedding ESG as an input into managing money, which again will probably lead to better decisions, one would hope, around thinking about climate risks in the portfolio, if nothing else. But as he rightly pointed out, ESG strategies are not themselves out there looking for solutions to climate. That's not even what we're asking portfolio managers to do when they're managing a diversified ESG strategy. But where you start to get in, and this is definitely to your question about where a lot of clients are interested, is in saying, okay, I want to find the solutions. And, I've been doing this for 13 years now, and I'm thrilled, I have to say, that I'm at a point where I feel like I'm at least defending less. I spend less of my time defending that this is not a place for just concessions or where you're going to lose money. It's flipping on its head. And now with the opportunities in the marketplace and what we're seeing, whether it's, from this SPAC craze or whatever, but putting even that aside, what we're just seeing in the market are real opportunities for people to lean in and look at growth in their portfolios, but to have an impact. And so this trade-off is just or the notion of this trade-off, I feel like, is really minimizing over time. You still have to conduct due diligence. Are there frothy valuations going on in this space? Absolutely. But it's a really exciting time for clients to think about that. And as I mentioned earlier, this is across asset classes. So, I'll just mention briefly, but I know some of the other panelists are managing the strategy, so they'll have much more to say on this. But, if you look at listed equities, you can find opportunities to play either, for example, a circular economy theme, a clean energy theme. I know Alan already alluded to this in some of his opening remarks, and that clean energy theme is not just about playing renewables. Peter mentioned real estate. Well, what are the enabling, different technologies or solutions, or, whether that be pumps and HVACs and LED lighting, there are ways to play those enabling kind of technologies and improvements in listed equities. You get into the circular economy, it's not just about recycling. It's about, our companies evolving their own reuse and recycling practices. What are the actual alternatives, like playing aluminum or playing, cardboard, et cetera. So I'm giving examples within listed equities where, this is not just about finding the next car manufacturer or the next solar developer. It's about all that goes into making those things possible. And then similarly, do you think about that on the private side as well? It's been a more obvious place to play things like climate change solutions. And so it's still a prevalent and relevant part of what we're trying to build for. And, happy to get into some more of what we've done there. But that's really what we're able to find, is that you're going from removal, which is really important to some of our clients, and we see assets flowing there, but really to having high impact. So the full spectrum, and you just think of climate as the topic and you weave it into really anywhere in the portfolio.
Right, well, that's great. It's really interesting to hear some areas of opportunity. And I noticed that JP Morgan Private Bank recently launched its Impacts Fund, which I'd like to talk a little bit more about and get a better idea of the kind of things that the opportunities and the solutions that you're looking for to invest in through that Impacts Fund. So would you mind maybe telling us about some of the kind of investment themes that you're looking to pursue through that vehicle? And take it from there.
Yeah, absolutely. This was something we were really excited to launch in September of last year, and it just closed. We are, it was the first time coming to market for us with a diversified, across several different managers, effectively a fund of funds of impact investing funds in private equity and venture capital. And so, as the private bank, we often just do, single funds and bring clients single funds, and they can choose to invest in those. In this area, one of the things that there was a variety of reasons for doing this in sort of a fund of funds construct, but one of which is, we are large, we do, we have a necessity to deploy a lot of capital, and in some cases, versus, the funds, if they're small, it just becomes a little bit more difficult. But getting to pool together several different vehicles allowed us really to, alter that math a little bit on the sides that we could even go into. And we also, candidly find there's a lot of talk and a lot of interest from clients. But one thing I still do notice is that sometimes when it just feels like one rifle shot or one thing into like a highly, specific education fund or a highly specific climate solutions fund, it feels like, oh, I'm not sure about that. That's feeling very sector specific. So we were sort of testing the theory that if we made it more diversified, clients might actually really feel comfort around that in a new area. Impact investing for some is new. There's a lot of interest, but it's still new for a lot. So that was kind of a little bit of the rationale. But what we also said to ourselves was, a lot of funds are aligning to the SDGs, but the SDGs themselves aren't necessarily an investment construct. And so when you think about investments, they align to several of them, but not all of them. And when we looked at, years of doing research on different funds in the market, we thought that we reasonably could build a portfolio that aligned to three key themes, which was inclusive growth, things like, education, diversity, workforce, upskilling, et cetera, health and wellness, hoping to find things that are maybe focused on digital health and healthcare kind of innovation, but also, more broadly thinking about things like, health and wellness, consumer products, and food and ag. And then, of course, climate solutions. And all that you can imagine would go into, a lot of these adaptation and mitigation efforts. And so that's where we landed. We are building for a fund that'll probably have about 8 underlying vehicles. And those funds, some of them are multi-strategy themselves, so they might straddle across all three. But we do have some very, targeted funds within there, like an ed tech fund and like a, mostly climate solutions oriented fund. And I think one other thing that's important about the private markets is the bar is a little higher to really think about reporting. Clients really want to see outcomes. Like a lot of times, like an ESG or a lot of these other things are about inputs. And you think about like, let's evaluate the manager and, the funds they're picking along certain traits. But in private markets, you really have to report on the outcomes we found, and that's of interest to clients. And so important to mention that as part of doing the work, we partnered with Tideline, who's a great partner to us in thinking about through all these issues about evaluation through to impact reporting. And so we'll be putting out, we don't have one to report on yet, we just closed the fund, but we will of course consider ourselves on the hook for doing some pretty detailed client and impact reporting going forward on that fund.
Great, that's very interesting stuff. Again, if we have time, I'd like to come back to you and ask you more about how you kind of select those managers, the fund managers that you invest in. So next, I would like to turn to Andrew, and Andrew, I'd kind of like to explore in more detail some of the things that you mentioned in your opening remarks in terms of the profile of clients and where you invest. Could you tell us a bit more about those types of investments and why corporates are increasingly looking to understand and mitigate their climate impact? What are the drivers behind that, do you think?
Yeah, sure. So in the impact world, we typically find sort of three main types of investors. One of which is obviously the DFIs, the development banks, and they are the core support for many impact fund managers over a long period of time, particularly around the debt space. And then you have, historically, you have the private wealth, high net worth, endowments. So people with a mindset around creating change through the use of capital. And that's really been a big part of the impact space as well for a long period of time. The big financial investors, by and large, have been absent, and we've spent a long time trying to educate them. Many meetings across big financial investors across Europe and the US, and they all express great levels of interest. They're all very engaged around seeing the need for it, but they're very much constrained by the fiduciary duty to make the best possible investment return for their investors. And this becomes a problem, particularly as we heard earlier on, where there's a cost on top to the process of, let's say, the impact reporting, the process of investing impact, where you genuinely are going to try and benchmark the change you're creating. It always ends up basically being somewhat of a drag on return. The other problem historically has always been the size of the investment, the ticket size per investment per deal, has typically been much smaller than other real assets such as real estate or infrastructure. And that also leads to a drag on returns as well, particularly when you're trying to create impact through the use of capital. You're not trying to use capital for the best return you can and then measure whatever impact you happen to generate. It's two different approaches. So that leaves us with the third bucket, or the third driver of capital in the space, which has become the corporates. And if you look at the reasons why that's the case, a lot of it comes down to, I think, one of the more successful organizations or groupings at RE100 that's really gained traction. Now, it's been obviously hugely beneficial that renewable energy has become so cost competitive to the point where it's the cheapest form of newly established energy in many parts of the world already now, and it continues to decline in cost per kilowatt hour generated, and that's the main reason why we've seen such a growth in renewables. Obviously, the feed-in tariffs originally helped, but if it hadn't got to that stage of competitiveness, we wouldn't still have that industry growing as quickly as it does. And within that, corporates have said, okay, well, how do I then do that? And, can I contract to the grid? Does it make sense just to say we buy renewable energy? And then it turns out that most grids can't supply 100% pure renewables. You're very much at the beck and call of what you believe you're getting as a percentage of that. Or you can just go out and buy credits, obviously, but that's a cost. So now all of a sudden your own cost of business is degraded by it. And I think one of the debates that we all need to hear more of is going back to the green bonds for a moment, is this green bonds are more expensive or trading at a higher premium to non-green bonds? Well, that's because pollution's not dragging down the returns of the non-green bonds, and pollution doesn't drag down the return of profits. And ultimately, pollution isn't dragging down the corporate profit that you could offset by buying renewable energy credits that would effectively alleviate that cost. And so it's to all of our detriment that we don't price pollution effectively. Now, what's gone on then we've seen is that the corporates have said, okay, well, actually to own the story with credibility, we're going to invest in renewable energy power production ourselves. We're going to buy the renewable energy. Google have been huge in the space, for example, because of all their server usage. And we've seen other corporates do the same sort of thing. But what we've seen most of is those corporates buying it for their own behalf. And what we've been engaged in more recently over the last 3 years is actually doing that for a company and the supply chain, the original equipment manufacturers, if you like, the OEMs that supply the products to that topco from their production base, be it in somewhere in Southeast Asia in particular. And the topco saying, look, that's not actually our usage, but in a way it's our footprint. And because of that, we actually own the obligation to address it. So they've worked with their supply chain partners to effectively build out the scope of their emissions footprint and understand fully what they genuinely are responsible for emitting. And then they've created or asked us to create a fund structure where all of those companies come into the fund as limited partners in proportion. They put the capital in proportion to their energy usage, not in proportion to how much they have available or what they think the return profile looks like in terms of attractiveness or any other sort of formula. It's just purely in proportion to their energy footprint. So they invest in the fund in order to acquire enough energy, renewable energy, to offset their carbon emissions that they generate on behalf of the topco that they're sending products to. So this is a very innovation driven structure, because ultimately what we're really saying is that you can attribute pollution and emissions directly to individual companies, and those companies can go ahead and buying the renewable energy rather than just buying credits. They're effectively creating a balance sheet asset that they can write up onto their books that gives them a yield as well as offsetting their carbon footprint. So it's an investment process. It's an investment business. We're an asset manager. We're doing this because it's a fund structure with multiple people in that fund. So there's a fiduciary obligation to treat everybody correctly. But it's also financing climate mitigation in a way that I think we could do with a lot more of, because ultimately it's inspiring further rounds of corporates to look at their own supply chain and see what they should be doing around it. And the corporates are doing it fundamentally because they're trying to protect their brand value. There's going to be a point in the future where you're either a climate criminal or you're a climate solutions provider as a brand. And the people who have the best corporate long-term vision understand that, and therefore they want to be on the right side of that branding long-term for their business.
Right, thanks, Andrew. That's a really interesting case study. And in terms of the kind of financial characteristics of the fund, kind of the returns that you're looking for on that, you mentioned the investing, or the clients are predominantly in Asia, also in Africa, and some in Europe as well. What kind of you're seeking a financial return on top of that as well? Could you give us some idea, if not perhaps the exact figure?
Well, certainly. So it really actually breaks more down to the equity versus debt characteristic of the process. So, typical equity returns have been around about the 10% mark for acquiring renewable energy plant and holding it in a portfolio and generating, obviously, the power that you're then selling as well as the credits. And that effectively that yield is offsetting your current energy footprint, as well. When you go to Africa or Europe, so particularly in Africa, the biggest issue there is risk mitigation. And so that's where the DFIs play a major role. So the Green Climate Fund, which we're partnered up with and have for some time, is involved in supplying, effectively first loss capital to a tiered capital structure fund for debt around investing in renewable energy, substitution of fossil fuel energy for businesses, and also the establishment of renewable energy for villages that are badly off grid and would otherwise be waiting for power lines to be laid to their location to give them electricity for the first time. And those returns are lower. I mean, those returns on a debt basis are more like sort of 4 to 6%. But with first loss capital involved in it, your risk profile changes from being sub-Saharan African risk with currency exposure, political instability, economic risk, to being much more a function of the size of the first loss provision supplied by a DFI and one Green Climate Fund, a function of the United Nations, as opposed to saying, well, we need outsized returns in order to compensate us for the risk we're taking of working in jurisdictions where we can't hedge out our currency or interest rate exposure to it. So it varies more by sort of the style of the financing almost than it does by geographic location.
Okay, well, that's very interesting. Thanks very much. So now I think we'd better move on to hearing from Holger. Holger, I'd like to ask you about, again, how you're kind of investing for climate adaptation or mitigation in listed equities. I think we had a challenge at the start from Peter to kind of explain in more depth how you're going about doing so. So it'd be interesting to hear.
Yes, and I hope you can hear me now better.
Perfect.
Coming back to this point maybe for a second. So what we do is we have an ESG integration framework, obviously, where we also look at all the different ratings, controversies, and we have exclusions, norm-based, value-based exclusions. But with this particular strategy, we are mostly interested really in the impact, which is scope 3, right? So this gives us also then a rather smaller pure play universe, and also the benefit that we do not have to deal with questions, do we need to exclude high-carbon emitters or not? It's just not the focus of our strategy. And just to give you an idea, we have defined 4 investment subgroups, again, with 4 subclusters. And you can see that it's really not about renewable energy anymore. It's just one hot topic also again today, but it's really broad, which includes sustainable infrastructure. So we are looking here at green buildings, water management. The second would be resources. This is more connected to renewable energy, but also forestry and nutrition. So how can we use resources in a better way? And directly connected with that is a subgroup we call waste mitigation. It's pretty much also about circular economy. How can you improve the recycling systems, the waste management systems? How can you introduce better, more sustainable materials, especially, for example, in packaging areas? And the last one is called carbon reduction technologies, where we really look at energy storage solutions and transportation. So this just gives you an idea. It's a broad framework, which gives us also the benefit to switch into one area or another area if we see any bubble-like valuations or if we are not happy with the developments at all. So, and then our belief also why we have the strategy is that environmental innovations will surprise on the upside. We think it's useful to look at solar and wind. Andrew also referred to that. What happened there over the last decade. So we saw the energy cost for wind, for example, onshore wind to drop by 40%, for solar PV by 80%. And today we see that electric vehicles take market share around 4% for battery electric vehicles, 10% if you include hybrids. And we believe this will also drive down massively cost for battery storage over the next years. And in the end, be a trigger for new markets to develop over the next years, like home energy storage solutions. But the essence is really the market is underestimating the magnitude of those trends. That's our belief, and that there will be more innovations and they will surprise to the upside, really.
Okay, that was very interesting, and I wanted to ask if you were able to provide examples of companies or the particular sectors that you think the opportunity is particularly great in. I think you mentioned some of the themes that you're interested in, but maybe if you could delve a little bit deeper there.
Yes, sure. I think currently maybe there are two major themes. On the one hand side, it's really the rising electrification. That's a long-term trend, and the reason for that is because of consumer electronics, increasing data traffics for data centers, the electrification of the mobility sector in passenger cars, trucks, but also now in the marine sector and later aviation. That's all coming. And then the second part is really waste generation and biodiversity loss. So those two big trends we see right now. When you go into the first one a little bit deeper, I think just to be aware that this shift is quite significant. We're talking about 50% of primary energy consumption will be electricity demand in 2050. And so we think it's good to look at the entire value chain there. When you take, for example, electric vehicles, besides the obvious OEMs, we find it very interesting to look at the content opportunity, because when you switch from a low voltage architecture to a high voltage architecture in electric vehicles, there are a lot of companies selling into this market which will benefit from that. So here we see, for example, connectivity suppliers set to benefit, and they realize maybe high single-digit growth rates over the next years. For waste generation, it's really about packaging, thinking about new opportunities in biodegradable packaging, replacing petrochemicals in a lot of different applications, also in personal care products. But also, and this is more connected to circular economy, but also to rethink how we use resources in general in the global economy. So are there opportunities to give them a longer lifetime? There are several manufacturers in the industrial space. They are looking into product as service solutions. And so they offer refurbished products, services to recycle or recycling options for customers. So we think this is a very promising area we also follow.
Okay, great. Thank you, Holger. And one of the things I did want to ask you about, perhaps if we return to you, if we have time, just wary of the clock ticking as we're talking, was the valuations aspect, and then you mentioned that some potentially avoiding some overpriced perhaps areas of the stock market recently, which has been well documented, but it'd be interesting to get your view as well. But moving finally to Alan from Wellington. Alan, thanks for being so patient and waiting to talk us through Wellington's strategy. So if you wouldn't mind just giving us more context around where you're investing, where you're seeing opportunities, and how you're looking to have positive impacts with regards to climate mitigation or adaptation as well.
Okay, terrific. And no problem. I suppose every panelist has to wait the same amount of time. But I would say that there are what I would consider obvious as well as non-obvious opportunities to invest. And I would argue over the past couple of weeks or months, you've seen some of these more obvious areas that reasonably did well last year underperform quite substantially to start the year. And so I do think it does confirm the value of having a broad, robust opportunity set, which, if I can speak for myself and the rest of the panelists, I believe most of us would say that that's what we enjoy in terms of what we look at today. To add to some of Holger's comments on where he's seeing opportunity, I think that there are some inefficiencies still in how securities are priced to get from today to this inevitable future. So I believe it seems almost a high conviction view, almost a consensus view, that electrification is inevitable. And I do share this view, but there is a distinct possibility that it takes longer to get to that inevitable future than many people perceive. And as a result, I think that there are opportunities in alternative fuels that are low carbon intensive, but are necessary bridge fuels that are also heavily supported by subsidies and incentives today that make the economics of these companies quite attractive. And I think that that is an inefficiency that is still remaining in the marketplace. Beyond some of the other comments that Holger mentioned, I'd say specific to green housing, there are opportunities in areas related to basic water infrastructure, as well as smart energy consumption, smart grid, as well as smart lighting infrastructure. There are a number of stocks that we've identified globally that will benefit from a secular demand for efficient energy consumption, as well as a cyclical benefit if and as the global economy begins to reopen. So we think that there are inefficiencies associated with getting from today to this inevitable all electric future, as well as the fact that many people have so focused on the supply stack associated with energy and natural resources and focused on this energy transition as it relates to the supply of energy that they've somewhat overlooked the demand side. The efficiency of demand also will undergo significant innovation and change. And there are public companies today that are focused on this.
Right, fantastic, thank you. And you mentioned, I think, the inefficiencies in pricing. Talking about pricing again, something that I mentioned as at the end of Holger's remarks, is it fair to say that some of the opportunities you identified there in electrification and also you mentioned basic water infrastructure, are there areas of the stock market where you're looking to potentially avoid some of the higher priced stocks that I guess we saw really balloon last year in particular? Where are you seeing the opportunities and how are you changing your strategy to adapt to that?
Sure. So I will describe just from a thematic perspective as well as from a stock perspective. So thematically, many of the more obvious areas related to this overall theme of climate have done quite well on a trailing 12-month basis. And so these obvious winners would be any of the companies associated with the growth of solar, the growth of wind, electric vehicles, and batteries. And you can see this largely reflected in the 70 plus clean energy / renewable SPACs that have come to the marketplace. There does seem to be a fervor for these types of stocks. And I would argue that a lot of this was encouraged by the success of Tesla, both as a company and as a stock toward the end of 2019 and going into most of 2020. From a thematic perspective, those areas have subsequently underperformed as we begin the year, at least so far. And then from a stock perspective, there does seem to be this idea that we are entering a period of rising rates or rising yields, or that certainly there's not significant downside once the US 10-year yield is getting close to zero. And in particular, if we are going to enjoy strong economic growth. And so as a result, the intersection of what has seemingly done the worst have been the obvious thematic areas, plus those that are long duration. And as a result, being able to shift or pivot out of some of those areas, the companies that are square in the middle of that type of intersection, I think has been advantageous. It's anyone's guess whether that type of shift continues to pay off. But for now, that it seems appropriate to be looking both A, non-obvious, and B, shorter duration.
All right, and just quickly, wary of time again, coming back once again to the discussion that I guess was kind of in some way started by Peter at the beginning about having impact in listed equities. Can I just ask you about that? How do you approach that aspect? Is it more about identifying areas that are potentially undercapitalized or requiring investment, or is it more about engagement? How do you approach that aspect? Oh, I think you're on mute, Alan. Are you on mute, Alan?
I'm sorry. I wrongly believe that question was directed toward somebody else.
Oh, sorry. I shouldn't have mentioned Peter. Sorry. Would you like to jump in on that, or shall we move along very wary of time? If you're able to.
No, that's fine. Just to verify, your question was on pricing.
Yeah. Oh no, I was specifically asking about in terms of how you have an impact in listed equities. Is that more through engagement, or is that another way that you find having positive impact through listed equities?
Yes, that's right. So one aspect of our strategies is to do our best to convey the environmental benefit from the companies that we invest in. The simple truth is that for some of these companies, tying the investment or the holding, the company, to a direct environmental benefit is easier than for others. So for instance, if you are a supplier of renewable technology, it's a little bit easier to map that the sale of a solar panel or a wind farm helps to directly avoid some amount of carbon due to the replacement of coal. On the other hand, there are other types of companies that are, for instance, related to, let's say, smart grid or energy efficiency, the demand side efficiencies, for which it seems clear based on either economic payback analysis or in speaking with the companies or the end users in terms of how that technology is used, that there is a significant climate dividend, but it's more difficult to quantify. So in our process, because we are looking for companies for which a material portion of their effort or revenue is dedicated to solving for climate in some way, shape, or form, we are tying that holding or that investment into a climate benefit to the best of our abilities, and we represent this in our key performance indicators, our KPIs. But admittedly, for some companies, it's a little bit more difficult to make that direct quantification or that exact quantification. So we do our best to show those KPIs. We provide fairly in-depth methodology to describe how we get to some of the numbers, and then we are constantly revising this.
Great, that's great, Alan. Thank you very much. So where we've got about 5 minutes left, I wanted to give a bit of time to take some audience questions. We've had one which asks for the allocators on the panel. I guess perhaps maybe if I can turn to you, Peter. We haven't heard from you for a while, so maybe give you an opportunity to comment before we finish. For the allocators on the panel, to what extent, if at all, have you integrated climate considerations into your strategic asset allocation process?
Well, I think that's a terrific question. And although we have a sort of a strategic target to be net zero, it's more still on the sort of stock picking level that we are considering the climate issue. So we still have the same allocation towards fixed income, equities and real assets and so on. And then so it's more on a tactical level so far. Although I should mention that the board each year is given a sort of a risk report, which we're stress testing the entire portfolio. So we're having that conversation, but it hasn't resolved yet in us shifting our strategic allocation. So we will get there, but for now, you should realize that the numbers is still there's a lot of assumptions. The data is good in some ways, and obviously it's quite poor, and also the methodology is sort of to incorporate in your strategic asset allocation process. It will take some time before we get, but I'm sure we will.
Well, that's great. and open up and give the opportunity to anyone else to jump in on that. If you want to raise your hand. If not, we've got one more audience question, which I think addresses the conversation around a bubble around green assets. It kind of refers to one of the things that Peter mentioned at the beginning about perhaps green bond prices being higher than maybe they have been historically, and also relative to unlabeled bonds as well. So the question from the audience asks is there a risk of a bubble in sustainable assets as green bond prices are higher, some trackers are at maximum capacity, I guess that's index trackers, and more investments are expected to be driven by SFDR. So I guess that refers to the EU Sustainable Finance Disclosure Regulation. So perhaps implying that that the identification of some of those sustainable assets by disclosure along the lines of SFDR and maybe the EU taxonomy might identify some assets, and then assets are going to flow in that direction, thereby pushing prices up. Is that something that that you think is a distinct possibility? Is it something that we should be looking to guard against? I don't know. Does anybody have any particular?
I can give my view very, very briefly. There is, of course, a risk when capital flows without sort of a fundamental, that are not fundamentally based. So that's a risk that you will see. But then, you know, there are participants in the financial market, and we consider ourselves being one that actually try to price in, you know, each asset. So that will balance out hopefully some of those bubble risks. But who knows? There's a lot of capital flowing in the ESG direction. So perhaps some of the other panelists have you know, some more insights.
Well, if anyone does want to jump in there, you'll have to be quick. We've got a couple of minutes left, but it's an opportunity to jump in if anyone wants to stick their hand up. Otherwise, I'll have to finish up. Jessica, did you want to?
I would just say, first of all, to the strategic asset allocation question, which I thought was very good. And as an allocator, I can say, you know, we don't really think of it that way, to be honest with you, because strategic asset allocation is what it is. And climate is then an input in a lot of different ways. One of which is just to think about ESG and sustainability risks across the entire portfolio. Either, you know, Peter alluded to security selection, but also just to thinking about how we evaluate managers. So I think it's an important input, but it's not necessarily driving asset allocation decisions today. And secondarily, on the other one, I would just say, you know, Alan kept referring to this notion of like obvious and non-obvious. And I like that construct. We've also referred to it internally as like the quiet enablers. So while there might be a bubble in some of these very obvious areas, there's a lot in which, you know, you can invest that is making a difference, and it's all out of the enabling infrastructure on the demand side, where, you know, there's plenty of opportunity going forward if you're evaluating companies appropriately.
Perfect. Well, I think we'd better leave it there and hand back to Manuel. But first, I'd just like to take the opportunity to thank our audience for listening in, but also importantly, thank each and every one of our panel members for your insights, and really fascinating to hear how you're considering climate mitigation and adaptation across asset classes. So thank you very much for your time, and thanks for your participation. Over back to you, Manuel.
Thank you, Michael, and thanks for moderating this panel. It's been a huge panel, and there have been lots of views, so that isn't easy. Normally, we do a quick tour de table and ask everyone to quickly summarize the key takeaways. Imagine someone hadn't had the opportunity to dial into this session, and they still wanted to know what came out of it. I'm afraid I got to ask you now then, Michael, can you give us a very quick wrap-up of what you guys have discussed over the past hour? Make it short and sweet, 1 minute strict maximum.
Well, it's so challenging because we heard across so many different asset classes how the investors are considering climate mitigation and adaptation. From my perspective, I think one thing that I would emphasize from what if I may just kind of take my own view, because it's so complicated to summarize exactly what we've discussed across so many factors, but I keep thinking and coming back to what one thing that will be a driving force behind getting some kind of fairly fluid consensus of where it's necessary to invest, and the financing gaps in climate mitigation and adaptation I think some of that we've touched on will be the policy and the regulatory side of things, where we've seen it bubble up with the EU action plan and so on. So if we can get to some point where we coalesce around a broad set of sustainability standards, I think we'll be going a long way to answering the question, where is the investment gap, and where are some of today's investors will see the opportunity. So apologies for my failure, I think, in being able to summarize exactly what we talked about across such a complex topic.
Well, that was good enough. Thank you so much. I mean, you got to summarize in 1 minute what 5 people have discussed in an hour. So you did well. Thank you very much for that. Michael, thanks to you and your panel. That was Holger Frey, Alan Su, Peter Lööw, Jessica Matthews, and Andrew Pidden. Thank you. And we will hurry on into the next session. But before that, we're going to have a break. So, ladies and gentlemen.